Hello, everyone. My name is Eric Lund, and welcome to the June episode of the Conference Board's monthly series, Economy Watch. This month, we'll be talking a little bit about the impact of COVID-19 on two economies in Asia, India and China. Um, Over the course of the hour, we're hoping to address both India and China's economy, and also touch on the U.S. economy and the global economy more broadly. Some of the questions that we're hoping to help you answer: what has COVID-19 looked like in India and China, and how has it impacted business operations in the region? How have Beijing and New Delhi responded to the pandemic? How have the economies of these two countries been impacted, and what kind of recovery is likely? And finally, how do China and India fit into the global economy, and what risks should business leaders prepare for resulting from these exposures? As always, we offer CPE credits for members of the conference board. There'll be a number of pop-ups that you'll see over the course of the hour that you'll need to click on. You'll need to stay on for the entire duration of the show, and you'll need to enter your information into the section at the bottom right of your screen. I'm joined today by two economists. Ottoman Özildrim is the Senior Director for Economic Research and the Global Research Chair at the Conference Board. Welcome, Ottoman.
Good morning, Eric. Good to be here.
And Abdul Ehrenbaum, who is the Senior Research Fellow at the Conference Board and an Assistant Professor in Economics at the University of Groningen. Welcome, Abdul.
Good morning, Eric, and glad to be here again.
Thank you. We were supposed to have our China-based economist Gao Yuan on as well, but due to some technical difficulties, he was not able to join us. But we'll still be discussing the perspective from China. I'll be helping out with that today. So, as is the case every month, the first thing that we like to do is do a quick snapshot of our current thinking on the U.S. economy. We actually want to start this section off with a poll question. That's for you, the audience, to provide your input. The NBR recently announced that the U.S. is officially in a recession. Some economic indicators suggest that economic activity has bottomed. However, is your business beginning to see any green shoots following the lockdown? Option 1, no improvement yet and none expected soon. Option 2, no improvement yet, but we expect improvement soon. Option 3, we are currently at the bottom. Option 4, some improvement, but only recently. And lucky option number 5, business is booming. So take a second to consider these different choices, and let's go ahead and lock the poll if we can. All right, poll is closed. So we're seeing an interesting. It looks like there's two peaks in this distribution. We have a 30% for no improvement yet, but we expect improvement soon, and another 30% saying some improvement, but only recently. Only 16% or so say the business is booming, versus no improvement yet and none expected at 12.5%. And then right in the middle, at about just under 10%, is we're currently at the bottom. So it looks to me that this is, it's either on one side or the other. It looks like either you've hit the bottom, or you're doing well, or there's not much improvement yet that you've seen here in the U.S. I wonder, Ottoman, if you have any. This is an interesting poll result. Do you have any insights on how the audience has voted here?
Yeah, Eric. Well, this is really not too surprising. I think there's a general sentiment that with the reopening of the economies, we'll likely see some improvement, and so the more positive results are probably related to that. But I think it is a bimodal distribution there. But I think we shouldn't be too short-sighted, and we'll talk more about that later on. And maybe don't get carried away with the very near-term results. and we should be a little bit cautious about wishful thinking too. It's great to be able to go out and start thinking about getting those haircuts or being able to go out to supermarkets in a more sort of freer fashion. But I think I would advise some caution here.
Abdul, do you have any reaction? I know that you're located in Europe. What does this look like from a
Fine.
European perspective?
In Europe, I think in most of the countries, the lockdown has been eased already, and some countries like Germany is slowly getting back, but it's still not there yet. But this number specifically in the context of United States, what came to my mind is that how does it corroborate with the recent uptick in the employment numbers in the United States. So there was some positive news in the employment numbers, even though there is a lot of debate about the reliability of that number compared to how it has been measured. But so that's what I was trying to to match it with actually.
Now we're going to talk about that a little bit more over the coming section. Let's go ahead and maybe pull out of this poll and go back to the slides. So with that perspective from the audience, I think it would be a good time maybe to review some of our data that we're tracking right now. Ottoman, do you want to talk a little bit about what the Conference Board Leading Economic Index for the U.S. is telling us at the moment?
Sure. So this chart actually kind of highlights why I'm a little bit less optimistic than our audience, perhaps. Our leading economic index is a forward-looking index that summarizes the business cycle. And in this chart, we're comparing it to the past episodes, like the 2008-2009 Great Recession and the 2001 recession, which came with the bursting of the tech bubble. And you can see sort of the different profiles there. And the COVID-19 recession, the red line, before it hit a peak and started to decline, it was really consistent with the economy kind of chugging along around its long-term trend rate. So no major recession risks. And that's the really unusual thing about the recession caused by the pandemic here. It suddenly meant that we had to stop business and commercial activity, and a sudden supply shock brought the economy to a halt, and that made the leading indicators turn down. Within 1 month, it took the LEI down a similar magnitude to what happened over 12 months before the 2008 recession. So a very different environment. But once this downward cycle starts, it becomes very difficult for the economy to turn around. So I think we have to be cautious a little bit, and there's really no sign of a fast rebound as yet. The only information we're getting is those better than expected employment numbers, which has some special reasons behind that with the reopening of the economies. And then stock prices are improving, but again, the stock prices are can be very volatile. So there's kind of a large grain of salt there to look
And
at.
don't necessarily
Yeah.
reflect what's happening. What happens on Wall Street doesn't always mean isn't consistent with what happens on Main Street. I thought it was interesting your point about this being such a unique a recession that we're in now. Officially, it's a recession according to the NBER, in that it was a supply side shock to the economy that is gradually evolving into more of a demand oriented shock that is consistent with more traditional recessions we've had in the past. So not only at the conference board, but at institutions around the world, there's a great deal of uncertainty in terms of how this evolves. And so you've seen a lot of changes in forecasting over the last 3 months or so. But as more and more data is generated, forecasters like us at the conference board become a little bit more confident about what we see likely to happen over the coming 12 months or so.
Yeah, and exactly. A lot of the components of the leading index are really reflecting that weakness in demand as we go forward. So the weakness in demand in manufacturing, the weakness in demand in residential construction, and also consumers. So if you go to the next chart, actually, our latest consumer confidence index is reflected in this chart. And we look at two components of that index. So, what do consumers think about the present situation, which is the orange line there, and you've seen it plummet, as we shut down the economy. And then the other component is the expectations. What do consumers think about the overall business conditions looking ahead 6 months or so? Um, and that's the blue line. And it's been hovering at historical highs, and it hasn't exactly plummeted as much as the present situation. That, along with the fact that there is that slight uptick there in the latest number, maybe suggests that the consumers are treating the kind of assessing the situation that's brought on by the pandemic as a temporary event, that they don't see sort of something particularly wrong with the economy, and that this will be temporary, and with the opening, things will get better. However, in the next chart, we can dig a little bit deeper, and this again kind of begins to highlight why we're so concerned about the demand elements in the economy. Consumers, 70% of the economy is consumer spending, so we track consumers very closely. The expectations component is pulled together from three questions about business conditions, jobs, and incomes. And while there is some recovery in what consumers expect about business conditions and jobs, they're still very concerned about the income situation 6 months hence. So that concern, I think, is a reason why demand is not going to be picking up very quickly, very fast. Even though jobs might come back, people are still experiencing furloughs, lower incomes across the board. So that concern about income leads us to be more cautious about a consumer-driven recovery, which doesn't seem to be in the cards just yet. So I think we have to be concerned about those demand conditions and a recovery that's based on the consumer going forward. And another survey that we don't have here asked HR executives about what they think about their own organization's revenues recovering. So more than half don't expect their business revenues to improve in the next 12 months. So if businesses aren't pulling in revenue, they're going to be more concerned about raising wages and raising incomes, and that's in the environment where we have a lot of labor market slack. Despite the increase in the slight uptick that we heard about in the employment numbers last Friday, the slack remains. We're still 20 million jobs below the February level. So that's not an environment that bodes well for increasing wages, and I think these numbers reflect that.
Yeah, and I wanted to get to that, Ottoman. I mean, one of the big components of consumer confidence and the willingness of consumers to go out and spend is how they feel about their income and how they feel about their jobs. Last week, it felt like we got some pretty good news in terms of the unemployment number. It ticked down slightly in May. Most economists expected it actually to rise. Could you walk us through a little bit of some of the particulars of these data and why we might need to be a little bit cautious in terms of how we read into them?
Yeah, so it was an interesting report. Many economists were expecting unemployment to continue rising. It was, what, 40.7%. In the previous month, it went down to 13.3%. And that's a reflection of the fact that many people are returning to their jobs. And the employment situation report really comes from two separate surveys. One asks establishments about the jobs on their payrolls, and that showed that 2.5 million jobs were added in May. But again, that's still well below where we saw the jobs in February. We lost 20 million jobs since February, and that's a big hole to climb out of. And then the unemployment numbers come from a survey that asks households whether they're employed or not within a given time period. And there, that's what determines the unemployment number, which was 13.3%. And there was a lot of technical debates among economists about, whether those numbers are reflecting the accurate situation or not. And there was, in fact, the Bureau of Labor Statistics talked about a misclassification of some workers that were employed but away from work that should have been counted as unemployed. If that had been the case, the unemployment rate would have been 3% higher.
But it
And
also may have been even higher in the preceding month as well,
exactly.
for similar distortions caused in some of the polling data. So either way, the data probably indicate that there was improvement in the employment environment in the U.S. for May versus April, but it's difficult really to put your finger on exactly how much better it was, and what kind of a trend we might be able to expect moving forward. Speaking of data distortions, there's also some interesting issues with some of the other U.S. economic indicators that we watch. Ottoman just talked about employment and some of the issues with respect to wages. We actually track data on personal income on a monthly basis and on personal consumption as well. Interestingly, if you look at the headline personal income data for the month of April, it showed a 10% increase in income across the board, which doesn't really make much sense when you're reading the headlines in the newspapers every day. But when you dig into the numbers a little bit more, what you find is that the amount of compensation associated with employees in terms of wages has indeed gone down as we would have expected it to. But the massive government transfers or social benefits that the U.S. government has been offering more than offset that decline. And as a function of that, you actually have that 10% increase in personal income. Moving forward, a lot of these benefits are going to start to be phased out in July. And so we do expect to see that headline personal income number go down, unless there's a more rapid improvement in the economy than we're currently expecting. One of the interesting things that spilled out of this distortion in the personal income data was that as this occurred, U.S. consumers were not spending 10% more. And so we had a spike in the savings rate that is almost unseen in the time series history. For the month of April, we saw the personal savings rate rise to 33%. Which is really an astounding number. We don't expect that number to hold up moving into the future, again, as the government support wanes, as the consumers continue or begin to feel, I think, even more so that wage hit. They'll be less willing to spend, and we'll see that savings rate drop back down again. So we want to maybe touch on quickly our outlook for the U.S. economy for this year. Certainly, as we mentioned earlier on, what we're seeing now is historic. The pandemic has set off a sort of an exogenous shock to the economy that manifested it on the supply side or among businesses first and foremost. And from that will spill out this damage on the consumer side or the demand side, which is more of a classical kind of recession. But we had a 5% contraction in the first quarter, according to official data. And the question mark that a lot of people are wondering is what kind of a contraction are we going to see in the second quarter, and what kind of growth are we going to see in the second half of 2020 and even into 2021? So at the conference board, for the last several months, we have been working very hard to try to forecast what potentially lies ahead for the U.S. economy. I mentioned earlier on that it's been very challenging to try to grapple with the level of uncertainty that we've been seeing, but over time we've become a little bit more confident in what we expect to happen in the months ahead. We've actually built a new model to try to approach how the U.S. economy is performing. Traditionally, we use an expenditure approach in kind of carving up the U.S. economy. That's consumption, investment, government spending, and net exports. You probably remember that from high school or college economics class. Instead, what we're doing is we're actually looking at the value that's generated across the the primary 15 industries in the U.S. economy and painting individual stories for what's happening in agriculture, what's happening in manufacturing, what's happening in the services sector, to try to come up with a more accurate view of what we think is going to lie ahead. When we started this process off, we had 4 different scenarios for what we saw possible for the U.S. economy in 2020. Over time, as we've gotten to see how COVID-19 has been evolving in the U.S. economy, what kind of measures the U.S. government has put into place, we've slowly started to eliminate some of those scenarios or to change ones that we had previously published. At present, we are down to 2 scenarios. Our primary scenario, our base case, if you will, is the gray line that you see on our screen. We call this the swoosh. We don't see a pronounced V-shaped recovery in the months ahead. We do see an acceleration in certainly May, June, and July as we come out of the lockdown, but the rate of growth on a monthly basis will probably slow later on in the year, as that demand shock sort of begins to manifest and U.S. consumers are a little bit more hesitant to open their wallets up. One of the big downside risks that we see to this forecast is opening up too slow or too quickly, or possibly a resurgence in COVID-19 for other reasons, because of perhaps weather and seasonality and things like that. So there is a possibility in our forecast for a second option, which is a W-shaped recovery. In this scenario, as you can see, we see a decline again towards the latter half of this year, and then damage to growth into 2021 as well.
Eric,
So that's
yes. One comment. If you go back to the previous chart, what that chart tells me is that, while we haven't seen such declines before, these happen during recessions, and it was really unusual that we were able to recognize it so quickly that it's a recession. That just points to the special nature of this. What the chart tells me is that we probably have a bit more ways to go potentially. And even though in spots or in some sectors we might see that those V-shaped rebounds, that's not really enough to turn the whole economy around. So for the overall economy, we would be seeing sort of still the declines, very large magnitude declines in the first half of the year, and then the future is as you see in those scenarios, and a big unknown is in those scenarios, as Eric was saying, is the uncertainty around how quickly we can come back, how stringent are those containment measures, and how willing are consumers going to be. Consumer psychology is changing about wanting to be out in those malls or in movie theaters. So as many people have second thoughts about that, I think that it really dampens down the recovery path. And then, we could be hit with the second or third waves, and that brings us a more these W shapes coming out.
Lots of letters in the world of these days: V's, W's, L's, U's. But Abdul, you had a comment too. What were you thinking about?
The next chart when you had those minus 5.7 to minus 6.1 contraction rates. So these are annual growth rates, right? Because 2020 over 2019. Correct. So do we have any historical parallel, like so much contraction, annual contraction in the United States? Do you know anything about that? Because the previous ones were quarterly declines, which you were showing.
So these numbers on the right-hand side, these are annual growth rates. So the first set on the left, minus 5.7, minus 6.1, that's the year over year for the entirety of 2020 relative to 2019. So during the global financial crisis, we had a contraction of, I think the peak was minus 2.5% for 2009, I believe it was, 2008. We have had some very, very sharp contractions on an annual basis historically. The next greatest one that comes to my mind was at the conclusion of the Second World War. There was a massive demobilization that took place in the U.S. as we stopped making tanks and warships and things like that. And so for a very strange reason, we actually saw a recession and a contraction in U.S. economic growth that was larger than these numbers that we're showing here. I can't remember what the number was specifically, but I do remember that it was larger than what we're seeing here. But that was, at the end of mid 1940s, late 1940s. So it's been a long time since we've seen something of this magnitude.
Yeah, it is really hard to find another episode that's very similar to this. I mean, obviously, we can learn from the historical episodes, but the economy hasn't gone through anything quite like this. There are elements of that. After the Second World War, you basically had to dismantle the machinery in the economy that was geared towards producing for the war effort and go back to the civilian economy. So a major reallocation, and it's likely that we'll see a similar kind of reallocation. That means the recovery path is going to be slower and more gradual until we figure that out, what the economy is going to look like, how are those resources going to be reallocated? Because clearly, some of those, the way economic activity is organized is going to be very different. A very simple example is that we may not be, working in offices as much as we used to, but that has implications for commercial construction, office space, and all of these knock-on effects. And until we figure that out, we won't go into kind of the full expansion mode. And that's why we're looking at the economy, uh, under a very sort of gradual recovery in these scenarios.
Mm. So I'm going to move forward a little bit. We have actually a corresponding expenditure breakdown for this base case forecast that you can look at after the webcast. We're not going to spend time on it now. We're going to quickly touch on the global economy, and then we're going to transition into the section on China and India. Ottoman, I think you're going to walk us through some of this material before we move on to the next section.
Sure. In fact, I mean, what we're seeing for the global economy is very similar to those scenarios that we talked about for the US. A very sharp contraction that's followed by a gradual recovery, and the economy, it really doesn't get back to where it was, at the end of 2019. And in this chart, we're kind of looking at mature economies and emerging markets separately. And the 2008 2009 recession was more of a mature economy recession, and the light blue line that you see there reflects that, compared to the light orange line. Emerging markets, flattened out. They did suffer from the great financial recession, but it was mainly a mature economy problem where you see the dip in the growth rate and the gradual recovery, which again took a very long time for mature economies. Compare that to the solid blue line, where we're already beginning to see that sharp contraction, gradual recovery. The economy just loses a lot, and it never really fully recovers back to the same level it was. Compared to that, emerging markets are likely to fare a little bit better, and that's still conditional on how much they're going to be affected by the pandemic and the outbreaks. And I think some of the discussion that we're going to have with China and India will help to get a better handle on that. So, I mean, I think we should look at these as provisional numbers. And even in that case, look at the recovery path for emerging markets in 2009, 2010, which was much sharper than what we're likely to see, a much more muted recovery going forward. So you could go to the next slide. Some of the elements of that recovery is listed here, and the as we move from a supply shock into a demand shock, for mature economies, that has implications for emerging economies as well. So they rely on manufacturing and exports to these developed economies. But that source of growth for these economies is being taken away, and the subsequent, even without the potential effects of the pandemic for emerging markets, the lack of demand is going to affect their growth outlook as well. I think in terms of the pandemic, the jury is still out on exactly how these economies will be affected. We still know so little about the virus and the outbreak itself. We're learning every day, but the we don't know if it's a seasonal pattern. So in the summer, it's going to go away and come back in the fall. The seasons in the southern hemisphere might be different, so their profile in terms of the pandemic might be different. So if you think about, Brazil, Argentina, Chile, or South Africa, they may still see those big pandemics that's going to cripple their public health systems, which are already less developed, and then have the consequence for the overall economy if they have to have these blanket lockdowns. And because of the demand situation, obviously that takes away demand for commodities and raw materials. We see declines in those commodity prices, especially for oil and energy prices. And we don't see that recovering, above the $40 per barrel level anytime soon.
Ottoman, we recently saw a lot of volatility in those crude prices. How much of that was a function of the demand lapse versus some of these shocks that we saw from producers?
Yeah, I mean, in oil markets, you're seeing really a supply glut. And OPEC and Russia are trying to kind of remove that supply by going through these agreements, which for the time being seems to be holding. But that's a big source of uncertainty. And then the rug has been pulled under the demand because China has gone through this contraction, and then the subsequent contractions in other places. So that's created the big supply shock there, supply glut. That adds to the uncertainty and volatility in those numbers. There are some specific reasons why, for a moment there we saw negative prices where producers were asking people to, paying people to buy their product, but that was more about bottlenecks in the supply chain, and the inability to store the oil that they were digging out. Um, so because of the unusual nature of the pandemic economy, I think we'll continue to see that volatility there.
We had a question from the audience about the savings rate that we talked about earlier, rising to about 33% in the U.S. and in other countries as well. But at the same time, we're talking about investors withdrawing funds. Is that contradictory, or how do we sort of thread that needle? I think perhaps one way of thinking about it is the distortions that we outlined in the personal income data in terms of the amount of government transfers are artificially inflating the income numbers. And so even though we've seen this pick up to about 33%, it's more of a quirk of the data that's going to be temporary, and we don't expect savings to remain high. We expect them to decline, especially as this process unfolds further. Consumers are going to have to rely on their savings in the future to offset some of the income declines that they've experienced. So in all probability, later in the year, it's likely that we see the savings rates decline to levels that were lower than what we saw before COVID-19 really took root.
Yeah, yeah, and there's a large degree of sort of the safety notion that you don't know what's going to happen to your income, that underlies the need to save more, and to the extent that social safety nets are less developed in emerging markets, that could also lead to emerging market consumers increasing their savings. Again, the domestic source of consumer spending might be taken away. I think if the question is about we're seeing investors withdrawing funds. That really refers to moving funds from emerging markets and investing in a more well-known assets that might be less risky in the U.S. For
The flight
example,
to
U.S.
safety,
companies represent
which
the
to a
flight
certain
to
extent could
safety.
be
Yeah,
responsible for some of the resurgence that we've seen in U.S. equities. Um,
right.
During times of turmoil, it's quite standard to see capital flow into the U.S., even if the U.S. is the source of the uncertainty, ironically. And as a function of that, you can have an increase in asset prices in the U.S. As a function of that. But maybe we can move on a little bit. We do have some details in terms of our current global economic outlook, where we make forecasts across the globe. We're not going to delve into this quite yet. Indeed, we published this about 2 months ago, and I think that our outlook has generally gotten a little bit worse for the global economy. So we'll be updating this over the coming months, and we'll release it on our website. Let's go ahead and get to the main event. It took a little bit to get here. China and India. We're going to start off with a poll question, and then we have a series of topics that we're going to go back and forth on in terms of the way that these two economies have managed COVID, what the government response has been. And Abdul and I are both going to weigh in on each of the slides to give you these two different perspectives. But let's get your perspective first. Will China's or India's economy be hurt more by COVID-19? Which will recover first? So option one, China's economy will fare worse, but will rebound faster than India's. Two, China's economy will fare worse, but will not rebound as quickly as India's. Option three, India's economy will fare worse, but will rebound faster than China's. And number four, India's economy will fare worse and will not rebound as quickly as China's. So let's give a few more seconds. We have about almost 200 people on, and we want to make sure as many of them vote as possible. Bigger sample size, more accurate information. So let's go ahead and lock that poll up. So it looks like we have a pretty clear winner here. India's economy will fare worse and will not rebound as quickly as China's. Interesting. I generally agree that India's economy is probably likely to get hit a little bit worse than China's has, just given the ability of China to really forcefully enforce quarantine and social distancing, and really kind of nipping this in the bud in a lot of ways. But in terms of not rebounding as quickly as China's, I don't know if I necessarily think that's the case. Abdul, do you have any thoughts?
I'm a bit confused here because the comparison between India and China is a little bit hard one in this case. But I fully agree that India will be hit very hard. And that's primarily because India was already on a slowing path. Structurally, India was already weak before the pandemic emerged, actually. And India then introduced a very unprepared lockdown, which affected substantial amount of informal sector workers and activities in India. And it is still beyond, the proper estimation is still not available. So I'm pretty sure India is heavily impacted. But at the same time, I also think that India will not recover, see a V-shaped recovery because, as I already said, the policy options are very limited for India. The government is very stressed by the fiscal situation in India, so its ability to spend too much is very limited. And the monetary policy has been failing substantially before the pandemic itself. Despite several rate cuts by the Reserve Bank of India, investors were reluctant to act and positively, and investment rates were not going up. There is a huge number of stressed banks in India. All these factors were already contributing to that. So the pandemic came over an extremely weakening economy already, which further triggered its weakening in India. So that would make India's recovery slightly difficult. But at the same time, I also don't think that India is going to fall off the cliff because it's one of the youngest economies in the world and with an economy with huge potential. So my estimate is that India will recover in a year or two, but not quickly, of course. Not in 2020 is not going to be a positive growth, and also 2021 is going to be challenging. But by the end of 2021, I expect India to come to the positive territory.
Ottoman, so I have a long history covering China. Abdul has a history covering India. You're unbiased. What are your thoughts here?
Well, I think China went into the pandemic lockdown very early on, before everybody else, and there were the measures to contain it was very drastic. So we are seeing sort of a return to closer to full capacity for the economy. But I'm a little bit more muted about the rebound for China's economy, because it's likely to depend a lot about what consumers will do. So you can bring the factories back online, but it doesn't mean that consumers are going to take off. Plus the lack of global demand for what those factories are producing. So maybe a more muted recovery for China relative to India. Because of the time advantage, we might kind of see greater recovery for China than India. I think for India, I don't know as much as Abdul, but I'm concerned about their post lockdown economy, whether it's going to be able to get the pedals going as smoothly as possible. So we might see more volatility there.
Okay, well, I want to stop. We've gotten a little bit ahead of ourselves because we're starting to kind of encroach on some of the material that we have prepared. So let's pull out of this poll question and then maybe move into some of the specific topics. So the first topic that we have that we're gonna delve into both China and India is related to COVID itself. So there's sort of three questions that we want to ask in this area. The first is when were the first cases of COVID-19 detected in India and China? At what point was it clear that this is going to be a pandemic? And when did new cases in India and China start to ebb? And what's the status of the pandemic now? So why don't we have Abdul answer or address those questions first, and then we'll pivot back to China.
The first case of COVID-19 was reported in the southern state of Kerala, which is one of the most globalized state in India in terms of workers moving around, workers going abroad as well as within the country, and also trade because it's a consumer state. So that was on the 30th of January 2020. It was a student basically returning from Wuhan. But the state of Kerala, which came from a Nipah virus outbreak in 2018, was quite cautious and acted immediately. They initiated substantial tracking, tracing, testing, and quarantine program with its relatively better primary healthcare system and localized approach compared to other states in India. The state have managed to flatten the curve pretty early by April. But this was widely discussed also in the international media. But the thing is that that was a very unique case. And that state also is now facing severe stress because many expats are returning back from Europe, United States, and Middle East. So this is really creating a hurdle here. But in the subsequent days after January 30, many other states also started reporting positive cases, and that really started going up substantially. So it was nearly 2 months after the first case was reported that there was a mounting concern among the Indian authorities that things are really going out of hand. If I remember correctly, on the 22nd of March, the number of confirmed cases was about 500, and the numbers were quite rapidly increasing. And it was at that point that the government of India decided to announce a 14-hour curfew as a test approach, and also issued a number of guidelines. But even before that, some of the state governments were also trying localized initiatives, which were also quite efficient and effective. But clearly by the end of March, things were really getting alarming for India. And between April 1st and May 1st, the number of infections in India increased by 20-fold actually. So as we speak now, as you can see in this chart, India is really red here. The number of confirmed cases of today is more than 276,000. And more alarming is that the daily rate of increase is almost 10,000 per day. And that is the reason why you see the number in this chart, which Eric prepared yesterday, is 10,000 less than what I said, actually 276,000. So, so far 7,500 people have been died. And there is also, the interesting thing is that within India, there is substantial variation across states, which makes it difficult to say one unique story about India. Some of the states like Maharashtra and Gujarat, which are the highly industrialized states, for example, Maharashtra is has Mumbai, which is the commercial capital of India. These states are among the most hit states, but also the national capital Delhi and the southern state Tamil Nadu are among the worst hit states in India. So these are also the economic hub of India. So the fact that these states are worst hit also creates a huge economic impact on India, while some of the northeastern states and the smaller states are less affected. So this is the kind of situation right now in India, because some of the most economically active states are heavily affected, and they are going to have a huge impact on the economy. And I don't know how the situation right now in China, maybe Eric can elaborate a little bit on that actually, yeah.
Sure. Yeah, so the situation in China, which is, of course, the epicenter of where COVID-19 originated in Wuhan, starts before most other stories do on this topic around the world. It appears that the virus first surfaced sometime in late December of 2019. But for a variety of reasons, it wasn't taken terribly seriously. There's reports that local authorities may have tried to downplay the severity of the outbreak, which of course ultimately ended up making it a little bit worse, or much worse, most likely. In terms of when it really became clear that this was a pandemic, it was probably around the Chinese Lunar New Year period, when in late January the government completely locked down the city of Wuhan on very short notice. People were not allowed to leave their homes. It was a very, very strict, highly enforced lockdown that didn't just apply to Wuhan either. It spread to other parts of the country as well. But certainly Wuhan was the initially the most affected. The government's approach to really being hard nosed about this appears to have paid off relatively quickly. The peak cases, according to the official Chinese data, occurred sometime in mid-February, and slowly has, more rapidly, I guess maybe I should say, has resulted in fewer and fewer new cases, to the point now where it appears that the virus has largely been contained within the country. Officially, the only new cases in China are ones that are quote-unquote imported from abroad. There were questions about the veracity of some of the Chinese data. We don't have any greater insight into this question than anyone else does. But I think regardless of whether or not you question whether or not there were still cases or whether or not there were more cases than were reported, the fact that China's system of governance allows it to take a very hard stance, where in a democracy that would not be possible, was beneficial in terms of their ability to confront this this disease. It appears that some of the pathways that we've been seeing in Italy and Spain, in the U.S., in terms of the ability to grapple with this and get it under control, don't appear to have been as big of a hurdle for the Chinese government. But we're going to move on. We still have a variety of material to go through, and not too long to cover it all. One is, again, about this government responses. What we're looking at here is an interesting index that's put together by Oxford University that measures the stringency of responses around the world to COVID-19 using a variety of underlying data. I'm not going to go into the nitty-gritty, but it gives you an idea in terms of how seriously the governments have taken COVID-19, the degree to which they've stimulated, the degree to which they've locked down or canceled sporting events, things like that. So the questions that I want to pose are, how did the governments respond to the pandemic and how severe were the restrictions? How successful were these policies at stopping the virus? And have restrictions begun to ease, and how much? Abdul, can you give us a little bit of insight on the picture from India?
Get back to that question which was there about the numbers that people have raised. Actually, I see that many have raised that question. In the case of India, also, I'm in fully agreement with that. The number is highly underreported. Also, another fact is that India also have one of the lowest testing rates in the world. So far, India has conducted about 5 million tests. In terms of absolute numbers, this is smaller than the United States, but it's higher than Germany, Italy, and other advanced economies. But when you compare it with the size of the population, it is one of the lowest globally. So that definitely tells you that how underreporting could be happening. So there is clear indication that the numbers are underreported. So the actual numbers could be much larger than what we are talking about right now. Now, coming back to your question, how did the government respond to the pandemic? As I said that earlier, first India announced a curfew, and then India announced on the 24th of March, India announced a 21 days complete nationwide lockdown. This was the largest lockdown globally because it required 1.3 billion people to stay home. Its impact is quite substantial, of course, the expected impact. But there was an unexpected situation that happened in India, which was the exodus of migrant workers. I'm pretty sure most of you have seen the insane faces of all those migrant workers moving from urban areas back to their home villages. So this was also showing you how urban, rural people, workforce who have been released from the farm sector where jobs are shrinking, are depending upon urban informal jobs in India. And these people who do not have adequate wages or any healthcare systems or even proper living situation, they were forced to go back to their home villages, and there was no transport facilities or anything. So this was creating a huge migrant crisis in India. So 80% of India's more than 500 million workers are informal. So these people were really the most affected people in India. So there was nothing much done in terms of preparation to take care of these people. And even after this event happened, the India government's response in terms of package or supporting package was very minimal and was widely criticized. But at a later stage, the government announced about $265 billion package to stimulate the economy, and which included a lot of infrastructure projects and also guaranteeing schemes for loans, something like that. Although it is a big defeat, this whole $265 billion as a fiscal stimulus, as a new money, because as nearly half of that was liquidity injections by the Central Bank of India, which has already happened before that, and also some part of that was already announced. But regardless of that, it was an impressive amount of money, which can, of course, really help the economy in the coming days, I think. And now coming to US, yeah.
Hey, Abdul, I'm going to interject here just so we can get through a little bit more of the material. So yeah, in China we had the sharp lockdown in Wuhan, and then a lot of restrictions have been eased. The Wuhan lockdown ended a number of months ago, but we have seen an uptick in some parts of the country in terms of the severity of some of these measures. I want to talk a little bit also, Abdul, about GDP growth, both going into the crisis and exiting the pandemic. You noted earlier on that the growth rate in India was on the decline. China was on a similar path, although perhaps not quite as as sharp. We at the Conference Board actually generate our own alternative estimates of China's GDP numbers. So we actually had growth probably around the 3 to 4% range, according to our metrics, and slowing over the last 5 to 6 years. Abdul, how much of an impact did the growth path have on India in terms of how they're grappling with this, and what does it mean for the recovery sort of pathway over the course of 2020 and 2021?
It even slowed down to 3.1%. So this was the lowest growth rate since the financial crisis. And the investment growth actually has contracted in the last 2 quarters of 2019 consecutively. So that was also very unprecedented. And it happened first time after the global financial crisis. Despite all attempts to stimulate investors through several policies, all the Make in India program and the different monetary policy announcement by the Reserve Bank of India, investment to GDP ratio has continuously fallen since 2012 in India, from 35% in the first quarter of 2012 to 26% in the last quarter of 2019, and that was equal to or close to the investment rate India had in the 1991 during its financial balance of payment crisis, which led to all sort of reforms in India. So this was the situation in India, and now we see that this continuous path of decline is going to happen. And I think that in terms of as per the available data, March was the worst month in terms of employment in the formal sector. For example, the new job additions were declining at a massive 46% according to the government of payroll data. And I'm pretty sure as the more data will come out, April and May will also show more weakening in India. For example, the Purchasing Managers Index for manufacturing has shown April and May were the worst hit months actually. So I think that the second quarter of 2020 is likely to be worse than first quarter of 2020. Now, coming to your second part of the question, how the recovery is going to be. So definitely the lockdown was the substantial blow to India's 2.7 trillion economy. There is no doubt about it. But and as I said earlier, most of the effect was on the informal sector, but the formal sector is also not spared. However, it is hard to predict the shape of the recovery in India at this moment. This is because there are too many variables that we do not know yet, and the data is quite weak at the moment. All that I can say, or I would say right now, is that if the virus could be contained without a second wave of infection, and the virus has still not reached the peak in India, you have to remember that, we can expect a move back from contraction to expansion to the slow growth phase of India, which has been continuing in the end of 2019, by the later months of 2021. That's what my expectation would be.
So for China, it's, as I said, it's a similar story in terms of slowing growth. Just for the audience reference, the blue line that you see here are the official numbers that come from China's National Bureau of Statistics in terms of GDP growth. We estimate that in 2019, China's economy actually grew at about 3%, and in 2018 at about 2.2%. So a fair amount slower than what the official numbers show. And our expectations are that we're likely to see a kind of swooshed shape recovery in China. Just as was the case in the US, as Ottoman discussed, there is a sizable hit to domestic demand that's currently unfolding because, again, China is further ahead of the curve in terms of they're further into the story than a lot of other countries are because they were hit first. One of the unique things that China has to grapple with, though, is the lapse in external demand. China's economy is hugely exposed to foreign demand from places like the United States and Europe. And as these economies are grappling with the pandemic currently, there's not as much demand for things that are made in China as there was, of course, last year. So there's sort of two demand elements that China has to grapple with. One is the domestic, and one is the external. And so, for this reason, we're expecting to see about a 2.8% contraction in China's growth for this year. Again, that's based on our alternative metrics, but we do expect to see a rebound in 2021 of about 7% or so. I see, unfortunately, that we're at the top of the hour. We do have some more material that we weren't able to get to. Please feel free to look through it. We're also available to answer questions if you'd like to email us. Next month, we'll be doing a similar COVID-19